Hi, everybody. Wanted to talk to you today about Chapter 8 of my book, which, of course, is available on Amazon. I'd love you to have it. From Insight to Upside, look it up and get in on the action of my book. Chapter 8 talks about free cash flow to equity models. I call them the queen of equity valuation models. Why do I do this? Well, a lot of people, like as we discussed in Chapter 7, talk about other measures, including price to earnings, price to sales, and of course the ever popular EV to Ebitda. All of those are very popular, and partly because they're very easy to calculate. It's a shorthand, and in the world of soundbite investing, I think it's pretty safe to say that if you're keeping score, those are good measures, but not the measure. Remember, you're buying a business, and a business exists to generate excess returns on your invested capital, or most importantly, profits, right? So free cash flow is the profit. That's the money that's left over after not only covering all of your expenses, right? Your operating expenses, your financing expenses, your taxes, but also the capital expenditures. So this is the cash left in the business after you've made what I would classify as your maintenance CAPEX. Maintenance CAPEX is the dollars that need to go out to maintain the property, plant, equipment that's used to run the business at flat revenues and presumably flat profits. Anything above that is what we'd classify as growth capital expenditures, right? Reinvestment in the business to grow the business. Let's talk about this again versus Ebitda. So free cash flow takes into account the cash interest paid. It would take into account taxes, and as I just discussed, the property, plant, and equipment depreciation that you see, the D in Ebitda. Right, we've already covered the I and the T. The D it is a real cash expense, right? Depreciation of equipment ultimately ties back into a CAPEX that's used to maintain that. So that's the free cash flow, right? So free cash flow would be the numerator. The denominator here is equity, right? So your equity is you could look at it two ways, right? You could say the value of the business after debt and preferred stock, right? So equity on a balance sheet, and this is the owner's percentage of the business, right? So there's the market value of equity as well, right? What you've paid for the stock multiplied by all the stock that's outstanding, right? So your free cash flow to equity is the money that's left over, and that you're entitled to. If you were 100% owner of the business, you could take this out, and you'd be assured that the CAPEX would be covered on all the operating expenses. So how do you value things this way? Well, one of the concepts that you need to think about is in building what they call a dividend discount model, right? So it sounds pretty complicated. It's not, right? If you were to buy a business that was throwing off free cash flow every year of $100,000, and it did that out to infinity, right? You calculated the free cash flow, you own a percentage of the business that generates $100,000. Somebody offered you the ability to buy that business. How would you take that offer, right? You would have to calculate in your mind what that business is worth, right? What's $100,000 a year in perpetuity worth, right? One of the ways to figure that out is the multiple based version, which we've talked about with PE, right? You say, well, other companies are trading at 20 times earnings. My business is just like them, 20. That's 20 times $100,000. Give me $2 million, sell out of the business, right? Well, think about this another way. So you take that $2 million out, right? $2 million equity valuation that somebody just paid you. That $100,000 is a 5% yield on that, right? 1/20th. How does that compare to the alternatives, right? So the alternatives across anywhere you could redeploy that capital. There's buildings out there that might give you a 10% yield, right? So you could put that $2 million to work and get $200,000. You can put it into another business. You could put it into the stock market. But the point is that the net present value of that $100,000 discounted back to the future, you just accepted $2 million, understanding whether or not that's a bargain or maybe they overpaid you is a function of understanding what the discount rate, that percentage, that 5% there, if that's the right number to discount your cash flow in perpetuity, right? It's all based on risk. It's all based, just like you would go and say a municipal bond might be yielding 4% for a very high quality municipality, a good city, and another one might be yielding 9. What's that telling you is the 9% is a riskier asset. All things being equal, right? You would say, okay, I need to be given 9% to compensate me for the risk of that municipality, right? That may be wrong. You might have special insight into that city and say, yeah, it's yielding 9% now, but that's because there was a big forced seller of a pension, and really that city is as comparable to the city that I'm invested in at 5%. Use the discount rate as an inversion thing, right? Invert and get the multiple, right? So you would say, in other words, with an equity, which is a perpetuity, not a bond, but it's a perpetual asset, right? Presumably, right? You own this forever. Is an 11 multiple or a 9% discount rate appropriate for the perpetual part of the business? The growth part of the business is something else, right? You want to divide up the business, I would suggest, into the growth piece and the perpetuity piece, the piece that with maintenance CAPEX and flat earnings, what that business is worth, right? So in the end, it's just another inversion thing. Like I said in the past video on chapter 7, PE, if you invert it, gives you an earnings yield. This is a free cash flow yield. You need to consider heuristically the relative riskiness, and that's where you get your discount rate. And in the book, we talk in more detail about that. And of course, I'll be hosting courses where we go into an even better analysis of how discount rates are derived. But conceptually, that's what that is. For those of you who invest in real estate, it's very similar to the cap rates that you look at when investing in commercial real estate. But anyway, that's a basic primer on free cash flow to equity. Thanks for spending 8 minutes with me, and we'll be back with more soon.